What is behind the chip sell-off?
Well, I mean, a lot of it's about economic slowdown. I mean, look, there's been a lot of analysts out there that have said that we're sort of at the end of a cycle, and this is a cyclical sector. And I think what you're hearing from companies, not only Texas Instruments, but you look at MKS Instruments, you look at a lot of the European chip makers as well, and you're just not seeing the kind of read-through into the economic conditions, whether it's building for computers or for smartphones or for cars or all the other items that are out there. We're just not seeing the read-through in terms of orders. So you're seeing an inventory buildup for some of these companies. You're seeing pricing pressures for some of these companies. And as they're giving forecasts for 2019 and beyond, they're really not giving investors anything to hang their head on.
So, Tore, do you see this as a sustained problem? Is this the new normal?
Well, it's a very good question, and if you look at the semiconductor industry, it's been very resilient over the last few years. And in fact, we're coming off 6 consecutive years of growth. If you look historically at the industry, I think the longest growth we've seen sustainably has been 7 years. So from that perspective, it's probably not a big surprise that we are starting to now see the reversal of the growth. But I think that the big topic here, of course, is really the actual tariff situation between the U.S. and China. And I think that's anyone's guess how that's going to progress going forward.
Romaine, walk us through what these valuations in particular are telling you in the context of what we're seeing in the broader tech market, which isn't great.
Well, yeah, when you look at the broader tech market, I mean, you're talking about a sector that was essentially overvalued, and it was very overcrowded trade as well. And when you start to look forward, again, looking forward at what the future earnings are going to be, what their revenue growth is going to be, and what their pricing power is going to be, for a lot of these companies, the outlook isn't as good. Look, we're still expecting 19% growth for EPS for the tech sector as a whole. That's good. That's high on a historical basis. But it's actually lower than what you're going to get out of the broader S&P. This is the first quarter during this bull market where the tech sector is going to have earnings growth that lags the broader market. And these are also the stocks, of course, that have had the highest valuations over the past 8 years. So at some point you have to say, okay, let's revalue this and let's take a look. You have a NASDAQ 100 now that's trading at 24 times price to earnings. Even when you look at price to sales to take in better account of the nature of these companies, it's still about 3.4 times sales on an annual basis, well above the S&P 500. And you have to ask yourself as an investor, do you want to pay that?
So, Tore, this is a space that has seen, tremendous M&A over the last several years, and then more recently a lot of failed M&A when you look at Broadcom, Qualcomm, NXP. Do you expect the current state to put a chill on deals going forward?
Yeah, I mean, M&A has been pretty tremendous in the space the last 5 years. But, we've been saying since the beginning of the year that that kind of M&A party is ending. And there's 2 reasons why. First of all, obviously, on the political front and certainly when it comes to regulatory issues, it's been very, very challenging to get M&A to go through, whether that's in China or the U.S. The other part of it, of course, is purely financial. So as, interest rates start to go up, cost of capital obviously is on the rise. And, once that happens, it's just going to be more and more difficult for companies to make the math work, especially for the actual acquirer of another asset.